Kroger recently announced earnings for the third quarter of 2023, their second quarter of their fiscal year. We can see over the last year, their stock isn't doing good at all. They're basically breaking even. And over the 5-year chart, they're up about 50%, while the S&P 500 is up 18% only over the last year. And then over the 5-year chart, they're up 46%. So over the 5-year chart, it looks like Kroger is outperforming the market, but over the last year, they've basically been breaking even. And so in this video, I'm going to review some of the recent news that came out surrounding Kroger's stock and their company, as well as their earnings. I'm going to look at their financial statements, and then I'm going to use a discounted cash flow model to find the intrinsic value per share for Kroger. So in this article, they touch on the fact that the economy right now is slowing down as a result of slowing down inflation, and that's ending up having a negative impact on the sales and earnings of a lot of retailers like Kroger. Right here, they point out that Kroger missed their second quarter revenue expectations as inflation cools off. And for grocers like Kroger, inflation contributed to higher overall sales as shoppers paid more for items that they wanted to buy. But because inflation is decelerating, some of that benefit is starting to wear off. We can also see right here, they point out that they missed Wall Street's expectations when they announced earnings, and the slowing rate of inflation will mean less revenue. They reported $33 billion of revenue, which is down from $34 billion year over year from last year. And we can also see that the company posted net loss of $180 million compared to net gain of $731 million last year. So they lost money in the third quarter of 2023. And a lot of that mainly came from this line item right here. Basically, they got sued they had to pay a settlement for a legal predicament they were in, where people were claiming that they contributed heavily to the opioid crisis. And as a result of that, they had to pay $1.2 billion. So that's in large part why their earnings decreased year over year. So it really didn't have much to do with their underlying business performance, just this one-time payoff for a legal settlement. If not for this, then their earnings probably would have been a lot higher, and they might have experienced a year-over-year gain from the $731 million gain they had last year. Lastly, right here, they point out some of the competitive risks that are coming up as a result of the changing economic environment. The slowdown in discretionary spending from customers for items that aren't really essentials is having a negative impact on a lot of retailers, but not much on Kroger because their shelves are dominated by necessary items. But that being said, they are not the cheapest alternative on the market. One of their main competitors, Walmart, is definitely cashing in on the fact that customers are looking for cheaper options. We can see that over the last year, Walmart is up 22%, while Kroger is basically only breaking even. So pretty interesting to see. We'll see how this plays out in the competitive landscape over the coming year. Obviously, everybody has their eye on the upcoming Kroger-Albertsons merger, and maybe that'll be able to change things up a little bit. So right here, we can see their financial statements. But before I get into them, I thought it'd be a good idea to explain Kroger's business model and how they make money so that we could understand their financial statements a little bit better. So to sum up, Kroger is one of the largest retailers in America by sales per year. Kroger is the only major supermarket that operates an economical 3-tier distribution system. And basically what that means is a 3-tier system includes producers, distributors, and retailers. Producers can only sell to wholesale distributors sell to retailers, and then retailers sell to consumers. And Kroger makes money by doing all three. They produce some of their own products and sell those to wholesale distributors, and then also distribute those products themselves. They also act as a wholesale distributor selling to other retailers, and then obviously they're also a retailer selling directly to consumers. So they make money in every tier of the economical 3-tier distribution system. Kroger basically produces products and sells them across a bunch of different areas in the market to consumers. And not only do they sell products in retail, but they also sell products online, and they offer delivery options to consumers' front doorsteps. So that's a basic summary of Kroger's advantage in their business model. So first, we can see in their income statement, sales were down about $1 billion from $34.6 billion to $33.8 billion. And then right here, they had a net loss of $180 million, down from net income of $731 million year over year. Right here, we can see on page 4 their balance sheet. They have total assets of $50 billion, and most of their business looks like it's financed by liabilities. They have $40 billion of liabilities, about $10 billion of equity, and we can see that for accumulated earnings, that line item has increased from $25.6 billion to $25.9 billion. Lastly, for cash flow statement, we can see that for the first 2 quarters of their fiscal year, their operating cash flow was $4.3 billion, which is up from $2.4 billion last year. And then we can see in their financing activities, they've paid dividends to shareholders amounting to $370 million. So they've returned a little bit of value back to shareholders, but considering the fact that shareholders are missing out on the returns they could have had by investing in some of the alternatives to Kroger, like Walmart, I'm not sure it's really enough to make up for the break-even share price growth that their stock has experienced over the last year. So to end off the video, I wanted to figure out the intrinsic value per share for Kroger so we can know if it's presenting a good buying opportunity at the current share price. We can see that the historic growth rate for Kroger's cash flows over the last 5 years was 11%, which is what I used for this discounted cash flow model. I used a 3.9% WACC metric to calculate their discount rate. We can see that their interest rate in their most recent full year was about 4%. Their beta was 0.4, so they're way less volatile than the rest of the market. Cost of equity was about 7%. We saw from their balance sheet, equity was about 10 or 20% of their balance sheet, debt was 80%. So to calculate the weighted average cost of all of Kroger's capital, we multiply the equity proportion by the cost of equity, add that to the debt proportion multiplied by the cost of debt, and then multiply the debt proportion by the tax shield, 1 minus the tax rate, because debt is a tax write-off. And so that gives us the weighted average cost of capital of about 3.9%. We can see that on their balance sheet, if you subtract their debt from their cash, they have a net debt position of $17 billion, and they currently have 719 million shares outstanding. That basically means that at the current growth estimates, their intrinsic value per share comes out to $51 per share, which means that at the current share price, they would be presenting a good buying opportunity if they're able to continue to grow at a 5 to 11% growth rate for their cash flows over the next 10 years. But that being said, obviously, we don't really know how Kroger is going to respond to the changing economic environment. So these metrics might not be that reliable. They might not be able to grow for the next 5 to 10 years at the same rate that they were growing at the last 5 to 10 years. But we'll see, mainly because of a lot of economic variables along with the merger that's happening with Albertsons. So right here, I wanted to compare them to 2 other retailers, Albertsons and Walmart, in terms of their operational efficiency. We can see that for profit margins, all these retailers are basically operating at the same level of efficiency. They all have about a 1 to 2% net profit margin. We can see that Albertsons takes on a lot more debt than Kroger and Walmart. They have a 9.3 debt to equity ratio, and the return on equity as a result is 65%, compared to Kroger and Walmart's about 14 to 20%. We can see that Kroger is currently trading at 20 times earnings, and they also pay a dividend yield of 2.2%, which is lower than Albertsons, higher than Walmart. So basically what that means is for every $100 you invest into Kroger per year, you're getting paid $2.20. So based on this, it looks like Kroger is pretty competitive in this industry in terms of financial ratios. But if you wanted to give it to the company with the best ratios, it would probably be Albertsons, because they have the highest net profit margin and they also pay out the highest dividend per share. Not to mention that they're also trading at the cheapest price at only 11 times earnings compared to Kroger's 20 and Walmart's 31. Lastly, I wanted to compare Kroger to some of the other companies we've looked at in the past videos on this channel in terms of their share price to intrinsic value, their growth rates, their profit margins, and their year-over-year earnings and revenue growth. So we can see right here that Kroger is basically coming in at 10th place. They were trading below intrinsic value per share, but not nearly as much as some of the other companies we've looked at, as you can see from this table. And then on the right-hand side here, we saw that their growth rate came in at around 14%, which basically isn't really that good, not good enough to get them onto the table. We can see AMD had the highest, 83% over the last 5 years. For dividend yield, Kroger had a 2.2% dividend yield, which is good enough to get them onto the table compared to all the other companies we've looked at. We can see that for profit margins, Kroger obviously didn't have impressive profit margins. It's very difficult to increase profit margins in the retail sector because of how competitive the price wars are. We can see that a lot of the higher profit margins in the market that we've seen come mainly from the energy industry with Occidental Petroleum, and then also from the tech industry with Adobe, Broadcom, Microsoft, Meta, etc. As you can see. We can see that for third quarter year-over-year revenue growth, that Kroger actually declined in revenue and earnings growth, negative 2% revenue growth, negative 124% earnings growth. And we can see that actually in the second quarter, Kroger came in 10th place, which was their first quarter of their fiscal year, with a 45% year-over-year earnings growth in the second quarter of the year. So since then, obviously, they didn't have as good year-over-year earnings growth in the third quarter, as we can see. And you can basically see the whole purpose of me creating these new tables on this channel for these videos. We're able to see the growth rate consistency for each of these companies, and that'll give us a better idea of if they're actually companies that are trading at a good buying opportunity or not. Lastly, on the right hand side here, we can see stock performance. Kroger didn't make it onto this table because over the last 5 years, they're only up 50%, which isn't good enough. We can see the number one spot went to Tesla with 1,000%. Pretty predictable. I mean, obviously, Tesla is going to be growing faster than a retail chain. That's not the main reason why I do the analysis. Obviously, it's not going to be fair comparing these companies against one another from different industries, but I still like to do this analysis just so that we can get a bird's eye view of the entire market. So let me know in the comment section down below what you guys think of Kroger. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.